So we are into the harmonic mean. See what happens as we have calculated the arithmetic mean, and we know arithmetic mean is average of some few observations, whatever you collect. Okay, but there are also certain observations which are in fraction form. Let's say a harmonic mean is used for certain computations. What kind of computation? Such as average cost of shares purchased over time. Okay, so here you can see an investor purchases $1,000 of mutual fund shares each month. He purchases $1,000 worth of mutual fund shares each month, and over the last 3 months the prices paid per share is this. So over the period of time, they are saying average cost of shares purchased over the period of time. So you can find out the you can see there's a way to find out average. Okay, the average can be found out through arithmetic mean also, and you can find out through harmonic mean also. But you give weightage to the minimum values, the least values. Okay, fractions are small values, so very small values you have and you're giving weightage to them. Or else, let's say if you have price to earning ratio, this will be in a fraction form. So if you find fraction forms, okay, if you see the data in terms of fraction, you can go for harmonic mean as well. Okay, the formula is like arithmetic mean only, but reciprocal of arithmetic mean. So we take the reciprocal of values, and number of terms is 3. So we get the average as 8.926 per share. So this is the like harmonic mean. If you take the arithmetic mean also, see, I am telling clearly, 8 plus 9 plus 10. Okay, 8 plus 9 plus 10 makes it 27. Divide by 3, you will get exactly 9. Okay, so this is what it is. Okay, and we have taken the reciprocal. We have taken the reciprocal of these terms and found out the average. We got the answer almost same, 8.9, and 9 is almost the same value. So now to check this result, calculate the total shares purchased as follows. So you have purchased $1,000 of mutual fund shares each month. So one of the months you invested $1,000 and per share value was this. One of the months $1,000 per share value was this. One of the months $1,000 per share value was this. So you have purchased 336.11 shares. And if you want to check the average price, you have invested in totality $3,000, and these are the total number of shares whatever you have purchased. So you see the average price per share is 8.926. So you can do in this way, you can do in this way. Okay, almost coming to arithmetic mean only. Please do this question. Since they have given returns, they are taking 1 plus. Okay, calculate this, we'll move forward. So when you do the calculation, you see you get 0.7369. This is the harmonic mean for this data. The relationship among arithmetic, geometric, and harmonic mean. Arithmetic mean into harmonic mean. Okay, arithmetic mean into harmonic mean is nothing but it is equal to the square of geometric mean. Geometric mean square is equal to arithmetic mean into harmonic mean. Okay, that means geometric mean is equal to under root of arithmetic mean into harmonic mean. That means if I take A, B, C, okay, arithmetic mean, geometric mean, harmonic mean, B square is equal to AC. B is equal to root AC. This is actually the formula of geometric mean. Okay, please make a note of this, and you should always understand. In general, when I calculate all of them, we have understood arithmetic mean we got was 9. Okay, arithmetic mean we got was 9. Harmonic mean we got was what? 8.9 something. Of course, this is smaller than this, right? So this arithmetic mean will always be more than geometric mean, will always be more than harmonic mean. Okay, even though you take approximate values. Okay, you always would find, if I give you a data to find out all the three means, you yourself will get the answer, and you yourself will get to know that this is always bigger than this and this is always bigger than this. Okay, and I already told you the proof is not in the scope of level 1 exam. Okay, more you should more look into interpretation rather than proofs. Next comes measures of average return can be affected by outliers. I already explained in the previous class that the arithmetic mean gets distorted because of extreme observation or outliers. So which are unusual observations in a data set. Of course, some 4 students got 5 lakhs, 6 lakhs, 7 lakhs, 8 lakhs package, but the last one got 1 crore package. It was a unusual observation. Two of the methods for dealing with outliers are trimmed mean. So what do you do in trimmed mean and a Winsorized mean? So what we'll do is we try to remove the outliers. See, we will examine these in our reading in statistical measures of asset returns. So what is that? See, what is this? Okay, this will take all the values including the outliers, that means extreme values. Geometric mean compound the rate of returns over multiple periods, because you have seen nth root of, that is compounding, you have seen all the values were getting multiplied, so compounding is happening. Harmonic mean average cost per from periodic purchases. Periodic purchase is what? Every month you are purchasing some stock every month. So particularly your data is showing that you are purchasing something over a fixed period of time. 1 month you purchase $1,000 worth of some shares. Another month you again purchase $1,000 worth of shares. Again third month you purchase $1,000 worth of shares. So every month it is happening, right? So if you have such kind of data whereby you have periodic purchases, and that too with a fixed amount of money, you go for harmonic mean. You have seen that. So you can differentiate the data, and you can accordingly apply the measures of central tendency to calculate the averages. Okay. So if you want to find out the average cost of a share, if you are making some periodic purchases like with some fixed amount of money over some fixed period of time, then you can go for harmonic mean. And then Winsorized or trimmed mean, decrease the effect of outliers. That means you try to remove the outliers from your data and try to find out the average. That's what they're saying, decrease the effect of outliers, and we will discuss that one, need not worry, in the coming sessions. Okay. Now coming time weighted and money weighted returns. See, my question to you today, do you have an idea about IRR or NPV method? Please tell me. Hello.
No, sir.
No, so leave it. So leave it. I will be taking up that chapter after this chapter, because time value of money is done. Okay, listen to me please very clearly. Time value of money is done. The next chapter what I'm going to take is capital budgeting or investment decisions. In that I'm going to teach these two topics, and then I'm going to explain you this one. Okay, because if I explain right now, you are not going to understand anything out of it. Fine. Now we'll do time weighted returns. Okay. Next. So now let's understand this one. Time weighted rate of return. You are giving weightage to time here. So first, how will you calculate time weighted return, rate of return? Value the portfolio immediately preceding significant additions or withdrawals. So you will first need to value the portfolio immediately preceding. That means before you are adding some kind of extra amount to your portfolio, extra stocks to your portfolio, or you are withdrawing some stocks and selling that from your portfolio. So before any addition or before any withdrawal, you need to first value the portfolio. Okay. Form sub periods over the evaluation period. Like 1 year is a total period. So sub periods will be 6 months, let's say, that correspond to the dates of deposits and withdrawals. Compute the holding period return. You already know what is holding period return. So the formula for 1 plus OHPR is equal to 1 plus R1 into 1 plus R2 into 1 plus R3. Let's say I'm taking for 3 years. If 1 goes there, it is holding period return is equal to 1 plus R1 into 1 plus R2 into 1 plus R3 minus 1, like that. Okay. So we will do a question you will better understand. There's a question in front of you. Read this question. Okay. So an investor purchases a share of stock at time 0. That means on the first day of the year for this much dollars. So the holding period 1, beginning value is this. Okay. At the end of the year T1, the investor buys another share of same stock for 120. Okay. So at the end of the year, he is buying another stock. Okay. So at the end of the year T1, that means Jan 1st, he buys a stock for $100. That is the beginning value. And December 31st, again, he buys a stock of $120. Okay, so beginning value is in front of you, ending value is in front of you, and the stock is giving some dividends as well. At the end of both years 1 and 2, the stock paid a dividend of this much. Okay, we have dividend as well. And at the end of the year 2, uh, the investors say, what happened? Okay, okay. Investor purchase a stock of $100 at the end of that is at the beginning, and at the end of the year T1, the investor buys another share of stock for rupees 1 for dollar 120. At the end of year 2, the investor sells both shares for 130 each. Okay, so whatever the shares he has bought, he is selling for 130 each at the end of the year 2. So 130 each, that means 130 into 2, 260. Okay, investor purchases a share of stock at some beginning of the period for this. At the end of year, that is T1, investor buys another share of stock that is for 120. Okay, at the end at the end of year 2, investor sells both the stocks for this. At the end of both the years, the stock paid. Okay, so dividend is paid at the end of the first year and also at the end of the second year. Okay, now for one share the dividend will be $2. For 2 shares the dividend will be $4. Okay, and this stock is sold at the end of year 2. That means this is held for a long period. So this, please understand, but he did not. At the end of year T1, investor buys another share of the same stock for 120 at the end of the year 2. Okay, so 120 stock we have, but how come we got 2 shares? Did not give any returns as well. Okay, the value of
I
the
I
stock.
think I think that the first thing has increased $20. So
No,
one
that
is like 100 plus 100 plus 20. Uh,
see
and he again purchased 120, right? So the beginning value is to 120 plus 120, 240, right? One
see
is 100 plus 20, another one is 120.
see that is our thought process, but I'm just looking whether like where have they given that data for me to understand that. So they have given something here. This is the same investment as the preceding example. So I cannot pre-assume, right? What is the preceding example saying? We will look into it. Okay, assume an investor buys a share of stock. Investor buys a share of stock for 100, and at the end of the year she buys an additional stock for 120. At the end of the year, to the investor sells both the stocks. Okay, at the holding the stock. So what was happening here? So this is the purchase. This is the year end, that becomes 220. Then dividend. From where they are assuming 120, it's a big shocker. Intuition is that we deposited 100 in the account, then added 118 to the account at T1, with which funded the purchase of one more share. We added 118 to the account. Yeah, so 100 and then 120, 220. So that value is increasing. There is no data about that. How come these people are giving such thing? It's a big question mark. Because I'm just looking, an investor purchases a share of stock for $100 at the beginning. Okay, yeah, that share is with them. Of course, they did not sell it, and that share is going to be with them for the next year as well. At the end of the year T is equal to 1, the investor buys another share of same stock for 120. That means the market value of this 100 has become 120 almost at the end of the year. You understood? Hello? Hello?
Yes, yes, understood.
Yeah, so this particular line shows us that the stock which is bought for $100 at the beginning, okay, has become 120 at the end of the year because he's buying at 120. That means at the end of the year, both the shares are 120, 120, and then again the closing value becomes the opening value for the next year. Did you understand? So when we assume something, there should be a valid reason for that. So I was looking for at what rate it is growing, or what at what price it has become 120. So the line here, the investor buys another share of same stock for 120. So while doing the question in the exam, please be very cautious. So this particular line is very important and crucial here. That means some stock which is bought at 100 at the beginning, the same stock is trading at 120 at the end of the year. That means this stock has become 120 now. Okay, and one more stock he has bought for 120. So two stocks now value 240 at the beginning of the year, and then it will be sold at 260 at the end of the year, and some dividend they are getting for like $4 because of two shares, right? So now the clarity, now we have got the clarity. So first what we have done is we have just seen the stocks value at the ending period. Okay, it was 100 at the beginning, it was, at the end of the year, it was 120, this stock, and also 120, one more stock has been bought. So that is 240. And at the beginning of the next year, we have 240 and we are selling it for 260, and dividend we got here, for 2 shares. Fine. Now they're asking calculate the holding period return for each holding period. So 120. Okay. So we invested 100. Listen. And it has become 120. Okay. Okay. And $2 dividend also we got. Okay. So 120 minus 100 plus 2 whole divided by 100. Can you tell me what's the return here? 22%, right? Yes or no? P1 minus P0 plus D by P0. This is the formula for holding period return, or you can use this formula also. This is for the first year. You bought a stock for 100. It has become 120. Now only we have just discussed, right? And then $2 dividend you got. In the second year, what is happening? You have two stocks right now, which first stock which has become 120, and the second stock which you have bought at the end of the first year, which is 120. Now your investment is 240. It has become 260. So 260 minus 240, and the dividend you got 4 whole divided by 240 you invested. Now you tell me the returns. Calculate.
10%.
Yeah, 260 minus 240 plus divided by 240, 10%. So it is in front of us. First year 22, second year 10%. So now what we'll do is, we know, find the compound annual rate that would have produced a total return equal to return on the account over the 2-year period. So 1 plus time weighted return whole square. See, when I speak about compounding, I take 2 years into picture. Okay, that is 1 plus time weighted return whole square is equal to 1 plus 22%, that is 0.22 into 1 plus 10%, 0.10. Okay, so 1 plus time weighted return is equal to 1.22 into 1.10. Fine. Now what we will do is, this is whole square. So I will do it neatly. 1 plus time weighted return is equal to 1.22 into 1.10. I am taking the square that side, it becomes root. So 1 plus time weighted returns 1.22 into 1.10 whole power 1 by 2, or square root. Now time weighted returns is equal to 1.22 into 1.10 whole power 1 by 2 minus 1. Can you calculate and tell me? So you should get this answer, 15.84%. Please calculate. And before that, something. So why did they do that? We could have directly done this, right? I would have directly put this into 1 plus holding period return is equal to 1.22, that is 1 plus R1, into 1.10, that is 1 plus R2. Okay. And just a second. One point. Okay. 34.2. Okay, so what they are saying is, to compute the product of this for each sub period to obtain a total return for the entire measurement period. Sub period is nothing but if it is half yearly, if it is quarterly, but they are saying very clear, if the total investment period is greater than 1 year, you must take the geometric mean of measurement period uh, return to find the annual time weighted rate of return. So you know the formula for geometric mean, right? Geometric return, sorry. What is the formula for geometric mean, whatever you have done? What do you remember? Nth root of 1 plus R1 into 1 plus R2. It will be going on. Okay. Okay. Geometric mean is equal to. So the formula is here. We have already done, and this is for more than one period. So when it is more than one period, you have to take geometric mean. See, it was for 4 periods, right? So they took fourth root. So here we have for 2 periods, right? So I'll show you. We have for 2 periods, right? So I can just put it like this. I can just put it like this. 1 plus geometric returns. Whatever. Okay, so I can just 1 plus geometric returns is equal to 1 plus 0.22 to 1 plus 0.10. Okay, whole power 1 by 2. That is nth root. So it is 2 years. So I'll put whole power 1 by 2. Geometric returns is equal to 1.22 into 1.10 minus 1. You can finish it off. But you should do the square root of this. Okay. So that is very clearly understood fact that you have to take geometric returns if it is for more than one period. Okay. So if you got this answer, shall we move forward? Please tell me. See, if square goes that side, it becomes 1 by 2. 1 by 2 is 0.5. Have you calculated? Please confirm. I am waiting.
Yes, yes, we can move forward.
Okay, Tarun, have you done?
Yes, sir.
This line you have to focus. If the total investment period, see the investment you have done at the beginning of the first year, then again you bought one more stock at the end of the first year itself. Again you bought some stocks not bought, in the sense next year in the second year, at the end of second year you sold both the stocks for some amount. So your investment period here is more than 1 year. That means you're holding the investments for 2 years. So they are asking to find out the geometric mean. If it is 5 years, nth root of 1 plus R1 into 1 plus R2 into 1 plus R3 into 1 plus R4 into 1 plus R5. So their n will become 5. So it will become 1 by 5. Fifth root of 1 plus R1 into 1 plus R2 into 1 plus R3. You're giving the compounding effect into 1 plus R4 into 1 plus R5. I told you what's the importance of giving compounding effect. So geometric returns, 1 plus geometric returns is equal to this. So if that means, see, by default in the textbook they have given the formula with all this minus 1. So 1 goes that side, it becomes minus 1, and you get the answer for geometric returns. Now we are coming into the last part of this chapter. Okay. See, please focus. Now you have to do the maximum calculations. Common measures of return. See, they are asking to find out annualized returns. Annualized returns means if the investment is held for 1 year period of time, then what returns you are going to get. That is the perception. So interest rates and market rates are typically stated as annualized returns. See, if you invest in some bond or if you take a loan, so interest rates are generally like some, here since they are speaking about returns, so I will tell you that if you have invested your money in some fixed income investment like bonds, so the interest rates are generally annualized returns kind of. Okay. And market returns, if you are expecting some returns from your investment which you have done in the market, you generally want to know what is the annualized return. That means if you hold that security for 1 year, what returns you are getting. So annualized return, very clearly 1 plus holding period return, and you have already calculated the holding period return, right? If it is like for more than 1 year, then what? If it is for only 1 year, then what? So annualized return that is shorter than 1 year. That means let's say your investment is for a lesser number of days in a year than 365. See, generally what happens when I speak about annualized return, I have to hold that security for 1 year. But let's say if I'm holding that only for 3 months, that is only for 1 quarter, then also I can find out my annualized return despite of myself holding the security only for 3 months. So what is happening and what kind of effect or formula you have to apply? So you have to take the holding period return whole power 365 divided by number of days you are holding that security. That means you are holding that security for 90 days, right? 365 by 90 is what? So you have to hold it for 4. The compounding will happen 4 times in a year. See, very simple. Why? There are 4 quarters in a year. 1 quarter is for how many months? 3 months, right? 3 3 3 3. So there are 4 quarters. So 365 by 90 is roughly 4. Okay, so that means the compounding will happen 4 times in a year. Why? See, first 3 months you get interest, then are you going to keep that interest with yourself? No, you're going to reinvest it for the next coming 9 months. Then after 6 months you're going to get interest, you're going to reinvest that for next coming 6 months. Again you're going to get the interest, again you are going to reinvest it for 3 months, again you're going to get the interest, but you're not going to reinvest it because the time is not there for you, the 1 year has passed by. So since it is happening always like this, you have to consider, give the compounding effect. Okay, so that's the reason why 365 by 90 would be almost 4 times the compounding will happen. The compounding frequency will be 4 times in a year minus 1. So first you find out the holding period return. How? You have invested how much? $100. Your stock has become how much? 100.75. Okay, or you have deposited this much in the bank and it has become 100.75 at the end of the year. So 100.75 minus 100, there's no dividend here because this is not any stock of a company, it is just a bank deposit. Divided by the invested amount is 100. So you get what? 0.75% is your holding period return. So you take that here, 0.75 by 100 whole power 365 by 90 minus 1. You get this much as your returns. Come on, do it fast. And also you do the second question fast. I'm waiting. Here the number of days are more than 1 year. So it is good. Still you want to make it annualized, right? They are considering number of days. So this will be your returns. Here your investment is for 500 days. So they are compressing it as per 365 days. So your returns for 500 days may be 3.09, but they want it as per 365 days. So you got 2.25. It will be less. Of course, if the period, if you are holding for less number of days, the returns would also be less than less than the returns what you will be getting if you are holding for more number of days. That's a natural fact. See, what you have got is 3.09%. What is 3.09%? 0.0309. 0.0309 is for how many days? It is for how many days? 500 days. For 365 days, it is how much? Cross multiply. 365 into 0.3, 0.0309 divide by 500. You get 0.02255. I have just done the cross multiplication. 365 into 0.0309 whole divided by 500. I got this. Now that into 100 will give me 2.25%. So that's this way also you can do. Okay, please make it fast and then I have to take it forward. If you are done with, please tell.
Yes, we can move forward.
Now, all of you may be knowing very clearly present value is nothing but future value into 1 plus r whole power n. See, present value is equal to future value into 1 plus r whole power n. This is when the rate of return is for 1 year and n is number of, years. Fine. So you just do one thing here. If it is for 1 year, future value into 1 plus r whole divided by 1. Since 1 year, right? Whole power n into, I will take m as the number of compounding periods in a year or compounding frequency. I'll keep this as compounding frequency. Now you will ask me a question, why, what is the relevance of this or why does it matter? See, it matters if you are holding the security for 1 year, but you get interest every 6 months. You get interest in every 6 months. That means the company pays you interest semi-annually. So that point of time you have to, half the rate. Okay, that means r by 2. Okay, 1 plus r by 2 whole power number of years is 1, yes, into compounding frequency will become 2. Why? Because the compounding will now not happen for like it will not happen only once in a year, it will happen twice in a year. 6 months you get interest, so you get the interest in the month of June and then you reinvest it. Okay, and then again you earn interest on this, like interest which you have reinvested, and again at the end of the year you get again one more interest. So compounding is happening here twice, please understand. Then if it is quarterly, so 1 plus r by 4 whole power 1 year, right, into the compounding will happen 4 times in a year. Acha, if it is 2 years, so 2 into 4, 8 compounding periods. If it is 10 years, 10 into 4, 40 compounding periods. Did you understand? So this is semi-annually, this is quarterly. If it is weekly, you have to take r by 52 whole power 1 into whatever 52. If it is daily, r by 365, 1 into 365. So like that you have to do. Okay. So now, and they are like telling to keep minus, minus in the sense one. I don't know why they are saying to do minus. I don't understand. It's like very simple. Whole power, you have to just do this compounding frequency into number of periods. Okay, number of years. Okay, so now I will explain this question to you. Compute the present value of some $1,000 which you are supposed to receive at the end of the first year, and the annual interest rate is 6%, with a range of compounding periods. Let's say you get the interest in every 6 months, so compounding period is 2. So you are making your rate as half, whole power 1 year, right? 1 into 2, so 2. If it is 4 by 4 whole power 1 into 4. If it is monthly, by 12 whole power 1 into 12. If it is daily, by 365 whole power 1 into 365. So you always get different answers. You see your answers are here. If it is annual compounding, rate of interest is 6%. Okay, and your present value is this. If it is semi-annual compounding, rate of interest, I know it becomes by 2, but the present value of found out is 942.60. Quarterly 1.50, monthly 0.500, daily this, and you see the values here. But what did you observe here? Please understand, all these values, despite of different rate of interest and different compounding frequencies, some like if it is daily compounding, if it is monthly compounding, if it is yearly compound, if it is semi-annual compounding, quarterly compounding, whatsoever, the values are very near. Negligible change you are seeing in this. See, 940 to 943, do you find any change in this? Just $1, but still there will be a change. Okay, fine. So this is what it is here. So this is daily compounding, this is monthly compounding, quarterly compounding, semi-annual compounding, yearly compounding. Okay. So now please calculate this and tell me. The question is here. Do the calculations. Okay. So why there is -2 here? Do you know this? In fact, why here there is minus? See, future value is equal to present value into 1 plus r whole power n. In the same way, present value is equal to future value by 1 plus r whole power n. Okay. So present value is equal to future value into, if this goes up, then it will become what? 1 plus r whole power minus n, right? That is the formula. Okay. Now do this calculation fast. Either you can keep it in this way, either you can keep it in this way. It's your wish. It's whatever you want, you can do. Are you calculating? Hello. Hello.
Yes, sir.
Okay. So previously what happened is I was like seeing this minus sign, but they are finding present value. So of course future value into 1 plus r whole power minus n only it would be. Why? Because you divide 1 plus r whole power n with future value, or you discount the future values with some rate of return to get the present value. So discounting is done here in case of calculation of present value, but in case of calculation of future value, you do the compounding. So when discounting, it is divided. If it goes up, it becomes minus n. So if this is done, shall we move forward? Hello.
Yes.
See, I'm giving you a small task. Can you do that task for me? See, you have just 2 minutes. See, just now what you did is you have found out the present values in all the cases. Can you just do some same thing? See, present value is equal to future value into 1 plus r whole power minus n, right? So future value is equal to what? Present value into 1 plus r. Okay, no. Let us not change the theme of the question. This is what you're going to receive at the end of the year. They're asking you to find out the present value. Okay. See, these are very near values. I very much agree with this. But one question I'm asking to you. See, with more compounding frequency, the value should increase more, or should uh, uh, like you know uh, increase less. My question is, with more and more compounding frequency. See here, daily compounding is happening. Okay, so you see, in fact, your future value, if you calculate, if I calculate future values for some X amount, if I have, see, let's say I have some X amount and I'm calculate. Okay, let's say my question is, okay, I'm giving you a question, just you find out at home, okay, and we'll discuss about that in the tomorrow's session. I want to ask you some question. My question is, write down, compute the future value, compute the future value of $1,000 as on today, received as on today. See, compute the future value of $1,000 received as on today for 1 year, held for 1 year. Okay, like that. Compute the future value of $1,000 received as on today and held for 1 year with a stated interest rate of 6% and range of compounding periods. That means monthly compounding, quarterly compounding. Okay, I'll write it here. Yearly compounding, semi-annual compounding, quarterly compounding, monthly compounding, daily compounding. Will you do it right now? You'll do it as a homework. So my question is, I am taking 1,000 right now into 1 plus 0.06 divided by 2 whole power 2. See, are you understanding? So what is your answer like this? If it is semi-annual, if it is quarterly, 1,000 into 1 plus 0.06 whole divided by 4 whole power 4. You just find out the values and tell me. Okay, that's a homework for you. Now comes the continuous compounding return. So for continuous compounding returns to be calculated, you will be using log function. Very clear. What do you mean by continuous compounding? See, you have come across right now regarding yearly compounding, semi-annual compounding, quarterly compounding, monthly compounding, weekly compounding, daily compounding. You have come across only this, right? I will tell you, there is one more compounding, hourly compounding. There is one more compounding, minutely compounding. There is one more compounding, secondly compounding. That means the derivatives market, the trade settle every second. The trade settle every second. So in that case, what formula we were using right now, future value and future value is equal to 1 plus r whole power, and this formula is not applicable. So what is applicable? In case of continuously compounding returns, you have to use the log function. So log into 1 plus holding period return, or you can do one thing, right? You can take this direct value, a logarithm of ending value upon beginning value. Okay, so here they have done log of ending by beginning, they got this return 18.232%. This is your continuously, this is the return which you get if at all you have purchased a stock, okay, held it for 1 year, okay, which has become 120, and you have calculated a return on the continuously compounded basis. So you got this return, okay, or else you can do it in this way also. See, we have already done this when we were doing. They are asking you, calculate and interpret major return measures and describe their appropriate basis. See, gross return is unadjusted return, from which we need to adjust lot of expenses and all. Let's say gross return I have I need to see if at all I have taken a security or I have taken a mutual fund or I have taken a SIP. You know, I have gross returns. They are asking, they are giving me gross returns of some 12%, but they are charging some fees also from me, management fees, administration fees for maintaining my accounts. 2% they want. So my net return is 10%. Understood fact. Then I get net returns, but I need to pay taxes of 30%. So minus I need to deduct 1 minus 0.30. So I will take 70% of this. So 7% is my post tax returns. This is my net returns before paying taxes. Okay. After I pay the taxes, I get the after tax nominal return. And you know what is nominal return, right? Nominal return is a return which has inflation factor in it. So see, I'll come here, gross return, unadjusted return, that is, let's say 15%. I have deducted management fees and all the administration fees of my account which the consultant or the management of a mutual fund company is maintaining. So 3% I deducted, so I get 12%. This 12% is what? It is still a nominal return, but pre-tax nominal return. Pre-tax nominal return. My tax is $2, 2%. Let's say. So it is 10% is my after tax nominal returns. Now this is my nominal return. So I remove the inflation from this 3%. So I get 7% as my real return. That's it. Okay. So this is what is the end of the concept today. Just a second. Now again, some topic need to be discussed. What is a leverage return? Okay, we will discuss this tomorrow, because before discussing this, I need to explain you what is futures contract, that you don't have knowledge of. There are four things which come in derivative. One is forwards, one is futures, one is options, one is swaps. So these all four are the derivatives. First we need to discuss about them, then we will understand about leverage returns. Okay, so only two topics in this entire chapter we need to discuss. One is the money weighted returns, okay, and one is leverage returns, to be discussed. I will remember, because next chapter what I'm going to take up is, let me see, without basics you'll struggle. So let me see what chapter we need to take. We have done this in this only, this is leftover, and leverage returns. We will go for statistical measures of asset returns. Next chapter we'll do this one. Okay, we will do this first one. Okay, and then after finishing three chapters from this, we can go for probability also, and we can go for portfolio mathematics. So 5 chapters I will finish from this one first, then I'll take corporate issuers. I'll take up 5 to 6 chapters from that. Okay, that is my target. So we are going in a flow, right? So it will become easy for you to understand all the concepts properly from quants, because students literally they fear from quants. I'll make that very easy for you. That's upon me. Okay, thank you.